Welcome to the price action series. This is the second video in our series, and today we are diving into one of the most essential concepts for traders: understanding volatile versus non-volatile trends. If you missed the first video in the series, don't worry. You can find the link in the description box below or by clicking the pop-up on your screen. Whether you're new to trading or you're looking to sharpen your skills, this video will help you analyze market movements with precision. So let's get started. Well, in trading, not all trends are created equal. Some are wild, unpredictable, and fast-moving. These are your volatile trends. Others are calm, they're steady, and they're easier to predict. These are the non-volatile trends. So what exactly is volatility? Volatility is how much and how quickly prices move over a given span of time. It looks at the rate at which the price of an asset moves up or down, and volatile trends will be characterized by sharp price swings and high levels of uncertainty. What you typically see will be pullbacks. So in volatile trends, there are a lot of pullbacks. There'll be a lot of pushbacks whenever price encounters support and resistance levels. And this is because there's a heavy presence of order flow from both sides of the market. Both bulls and bears are present in the market, and they're trying to fight it out to control the order flow. Where there is impulsive move, you'll tend to see large candlesticks. By large, I mean the body range is beyond what you'd see in the normal ATR for that particular pair. And this is usually during news releases, like the NFP. In the smaller time frame charts, like the 1 minute, you tend to see the body ranges being quite huge than normal compared to the prevailing, the price action that was prevailing actually before the news release. Yeah, there are two types of volatile trends. There's clean volatile trends and unclean volatile trends. For clean volatile trends, what you tend to observe is previously broken support and resistance levels have been respected. This is because there's less deeper retracements. The price action is very clean. It's very easy to decipher what is going on. And if you have a moving average on your chart, you'll see price respecting it. In an uptrend, price will always be above the moving average. And in a downtrend, the candlesticks will always be below the moving average. In an unclean volatile trend, price doesn't respect previously broken levels. You'll see deeper retracements. Price will violate the moving average. There'll be movement above and below the moving average, irrespective of the direction of the trend. And the price action is basically very unclean. It's hard to tell what is going on. And there's a lot of uncertainty. Non-volatile trends, on the other hand, will tend to be very smooth. They are steady price movements. And sometimes you'd see smaller candles, yeah. And it's basically a gradual trend, whether it's to the downside or to the upside, yeah. So some of the features you'll see for a non-volatile trend will be impulsive moves dominated by one color. This is because the order flow is strictly to one side of the market. There's an order flow imbalance. So the bulls, if the bulls are in control, you typically see green candles, very few red candles. Largely it will be green candles. So basically, when you see a trending move dominated by one color, there isn't volatility around that. Yeah, the price will move in very tight channels, and it's moving in tight channels because they are very weak pullbacks. These are not markets to be looking for retracements as entries or looking for counter trend trades. Yeah, these are markets where you just ride the wave. Yeah, you will see support and resistance levels being broken with ease. Price will not respect support and resistance levels. It will just break them, yeah, and continue in a slow, gradual manner with the trend. Yeah. So let us look at the examples and see the differentiating characteristics with the chart examples. We start by looking at non-volatile trends, and we have an example of a USD Japan weekly chart. There's a time that it trended really well. And you can see this market ticks all the boxes of the characteristics we looked at for a non-volatile trend. We see the EMA is being respected. We have not seen price close below the EMA. This is a 20-day EMA. We have not seen any candlestick close below the 20-day EMA. No, this is a weekly chart. So since this is February 2021 all the way through October 2022, the weekly chart was above the 20-day weekly EMA. We are seeing very few pullbacks. Yeah, remember we discussed that. Few pullbacks and weak pullbacks are characteristics of an unvolatile market. I think we only saw one serious pullback here. If you look at previously, where price was making new highs, very weak pullback. Price is consolidating, but it's not retracing to a previously broken level. So price is not respecting previously broken levels by showing weak pullbacks. Yeah. So market participants are not using previously broken levels as a reference. This shows that bulls are willing to buy this pair at a very high prices. Yeah. So the order flow is skewed to one side of the market. As you can see, we only have green candles. Green candles, the red candles are countable. Majority of this movement is just green candles. So just to recap, we have seen price respecting the EMA, very few pullbacks, very weak pullbacks, and candles dominated by one color, which is evidence that order flow is to one side of the market. The next chart in line is Bitcoin. There's a phase in Bitcoin which was non-volatile. Yeah. I just want to, let me grab my tool. You see this time before it consolidated. During this period, we are seeing a large number of green candles, very weak pullbacks. I think the only strong pullback we had was this point. I was closely monitoring this point. I remember this day clearly. This is the only serious pullback we had. But even after that level was broken, see, price never came back to the level. So if you are largely retracement trader, you'll have missed this entire movement waiting for a pullback. Yeah, so this is just an example of a point in time where price was non-volatile. We shift our attention to volatile trends and we start with unclean volatile trends. As you can see, this chart ticks the boxes that we discussed when we were looking at the characteristics of unclean volatile trends. We are seeing movement on both sides of the EMA, because ideally in a downtrend, you'd expect candles to be below the EMA, but you can see price poking above the EMA. So price is not respecting the EMA. We are seeing price making new levels, but those new levels are not being respected. As you can see, price made this low, broke this low, but what did price do? Bulls came into the market, moved price up. Price came, made that low, and when price broke that low, ideally you'd expect it to act as a level of new resistance before it continues to the downside. But what did price do? Bulls came into the market, pushed it to the upside, then came back and broke the level again. This movement here is clear evidence that the order flow is not imbalanced. This presence of both bulls and bears, and that's a key characteristic of volatile markets. Yeah, you will see presence of both bulls and bears. Unlike the USD chart that we saw, here we are seeing a mixture of candles. You can see a mixture of candles. Both bulls and bears are present in this market. Yeah, we can see a lot of greens, we can see a lot of reds, despite the general direction being to the downside. So if you want to short this market, it's actually tricky because the levels are not being respected. And ideally, if you're a trader, I'd advise you avoid unclean volatile markets because the levels are not clear and there's order flow from both sides of the market. So anyone can actually tilt the market to their favor. As you can see, we continue to the downside, just to zoom in out, continue to the downside, but the unclean nature continued. There are some points in the trend where it was a bit clean. Yeah, because remember, market moves in phases. It won't stay unclean. It won't stay unclean for long. Sometimes it might be clean. Sometimes you might see clear impulsive moves where you just have a move that is dominated by candles for one color. Like here, still candles for one color, but you can see here was a tricky market to trade. We went down, but tricky market to trade. Ideally, most of the time when trends are shifting, let's say like for this pound, we are going down. For it to turn again and become an uptrend, usually you'll see a phase, a consolidation phase, and this consolidation phase usually is usually an unclean volatile market. You see, price went down. So at some point, bulls decided we want to move it higher. So there's a lot of push and shove, push and shove. Price made a higher high. You'd expect it to respect the previous high, but no, came back, closed below. If you had a stop just below that previously broken, if you had a stop just at this low that led to the breakout, you would have lost this trade. Yeah, and until eventually the trend actually started moving upward. So important to note, sometimes when you see an unclean volatile trend, it could be that the market is changing direction. Yeah, so you just need to avoid such a market. So just to recap, we are seeing a lot of movement above the EMA. We are seeing previously broken lows not be respected, and we are seeing a lot of mixed candles. These are mixed colored candles. We are seeing both greens and reds, meaning there's presence of order flow from both sides of the market. The next example is the New Zealand dollar. This is the 4-hour chart. This is actually a recap of some of the recent trades that I took, just to show you how you can benefit from looking for clean, volatile trends. By clean, I mean previously broken levels actually been respected. Let's start from the top where the chart begins. As you can see, we were in an up move over here. Let me just grab a pen tool. We are an up move. Then the trend shifts. And in the trend shifting, at some point, price was non-volatile. Remember the non-volatile characteristics that we discussed? Look at this period here. Look at this period here keenly. Mainly red candles, no pullbacks. If you're waiting for a pullback here, you'll miss this move. Then price comes to a previous key swing point. This is a key swing point because it's the price bounced off that and led to that major move. Price broke that swing point over here. Yeah. After price broke the major swing point, this is where I took my first entry, because I loved how this trend had morphed. We moved from a very non-volatile market, as you can see, dominated by one color. Look at the previous key swing point. Look at how price behaved at the key swing point, meaning there were no bulls in this market. So there was a bias to the downside. And I remember I said forex is a mean reverting market. For me, whenever price breaks a key swing point, I usually use it as a point of reference. Yeah. So I just gambled, and so let me just try to see if I can get a retracement out of this market. And price did retrace, use the previous area as a point of reference, and in doing so, the market is actually shifting. It's moving from a state of non-volatility to a volatile environment that is clean. What do I mean by clean? Price breaks a level, price retraces to that level, and that level is respected. Price can poke through, but it's a very small poke through. Remember, price, this is not a science. It doesn't have to be completely perfect. Yeah, price comes to this low, respects it, weak bounce, then closes below. I took another entry here. As you can see, this is clean price action. Previously broken levels are being respected. Previously broken levels are being respected, and I remember trailing these markets, and I got stopped out when price became unclean. As you can see, this period here is very unclean. You can even see the moving average price, this movement above the moving average. Then eventually price becomes a bit cleaner, but I did not take this following retracement. And the reason being, price is currently at it's at a key support area, you see. So that's why I did not want to take a bounce. I didn't want to gamble. Yeah. But basically just an example of how a clean face in the market can give you very good trading opportunities. I want us to look at another example, the USD Swiss chart. Price had made this level. This is actually a key level. Price broke. I looked at it to retrace. Price retraced. Price broke above, came back. As you can see, the retracement. Yeah, we didn't get another retracement, but since I'd already taken this trade over here, I was able to ride that trend. Of course, I took partials because given, you can see we had seen a couple of pullbacks. So here is a clean volatile trend. So I did take some partials, but I usually leave something small just to ride out in case the market actually turns and becomes non-volatile. So this is an example of a face in the market that was clean, it was volatile, and my entries are pullbacks. As you can see, price is respecting the EMA. There are some points where it actually closes below, given it's a bit volatile, but overall it respects it. Yeah, and you can see there's a mix of candles. Yeah, the reds are not that many, but you can see the pullbacks are a bit deep, and they respect the previously broken highs. Yeah. Next, I want us to look at a very volatile chart. This is Audi New Zealand. Most of these cross pairs, your Audi New Zealand, your Euro Swiss, your Swedish krona, your Singapore dollar, you'll tend to see a lot of volatility that is not, and the price action is not clean, because the market is largely, let me say, illiquid. Yeah, we don't have a lot of people trading these pairs here, so they're characterized by very large spreads. You can see this market. How do you trade this market? So these are pairs you need to avoid. Look at the movement. Look at how price is behaving around the EMA. We have movement on both sides. Yes, it's ranging, but you can't even clearly define the range. Where is the resistance? Where is the support? We're seeing a lot of key highs in between. Yeah, You just want to avoid such pairs. This is an example of pairs you want to avoid. Once you see, I don't think even historically there's a period where we are so clean price. Yeah, at least there's one finally. There's one period, and this is 2013. This is a weekly chart. From 2013, we're not seeing any clean movement in this pair. If it doesn't give you good opportunities, just step out. Don't waste your time. Focus on clean price action. Yeah, so your focus should be on clean volatile trends where pullbacks respect previously broken highs, and non-volatile trends where the order flow is strictly to one side of the market. You can ride it. Just ride that wave, yeah, or just train pullbacks in clean volatile markets. I think that's the end of the examples. Having looked at some of the chart examples and the differentiating characteristics between the volatile and non-volatile, how exactly will you trade depending on the market environment? One, if the environment is volatile, you need to be taking breakout trades. And I'd advise you, especially for beginners, you need to focus on clean volatile trends, where there's presence of order flow from both sides of the market, which is typical of an FX environment. FX is basically a mean reverting market. So breakout trades work well when you're trading currencies. Look for breakouts and trade pullbacks. By trading pullbacks, I mean use retracement entries. Wait for price to break a level, then use that level as a reference for your next trade. Place an entry at that level, whether it's a limit. Most likely it will be a limit entry, and ride that trend and take partial profits. Remember, in a volatile trend, markets will pull back, so you want to take partial profits. In a non-volatile trend, on the other side, focus on trend following strategies. Just ride the wave. This is not the time to be taking profits. Ride the wave. You might actually stumble upon a trade that makes your year. It can be the make or break trade for you. It can actually be the difference between you being profitable in a year or loss making. It just makes the difference and makes your equity curve stand out here. Don't take counter trend trades. Remember, in non-volatile markets, the market is not mean reverting as much. So you might be hurting your P&L when you're taking counter trend trades, because the pullbacks are very few and they don't last for long. Yeah, just ride the wave because the imbalance is not in your favor. Just take the direction that is controlling the order flow and ride the wave. Yeah. For entries, given that we don't have a lot of pullbacks, you can look for candlestick patterns like the inside bar patterns, or you can look at strategies like taking stop entries above candle wick highs or lows, where you use an ATR. You can see I'm going to take an entry 2 times the ATR below this candlestick, low or high depending on the direction. Yeah, and just ride the wave. Yeah, that's all for this video in our price action series. If you found this helpful, don't forget to like, subscribe, and share it with your fellow traders. Up next in the series, we'll dive into support and resistance, an essential concept for mastering price action. You can check out the link in the description box, click the pop-up on your screen, or find the video card at the end of this video. Thanks for watching and happy trading.